So welcome everyone. In this video, I'm gonna cover the weekly gangs and weekly my trading strategy for option selling. Predominantly, I'm using Amazon, but I also use Tesla and Apple. But Amazon is the chief instrument I'm using for selling my calls and my puts options as a day trading strategy for making money, and it's a consistent strategy. I think is more consistent than any other strategy because option premium are quite high, and if you get it at the peak, or if you get it at the extreme, the point of the reversal, if you sell it at the low point and the high point of the reversal, you are bound to make consistent gains. So for um for the week, I made 8,400, and this is the best week as far as results, in the sense that I was positive 5 out of 5 days. This is my first positive 5 out of 5 days as far as making gains every day. So that consistency is what I'm looking for. Next week I'm looking for the same consistency, but I'm hoping to have more gains, like 3, 4, 5,000 per day. You can see the Fridays is where I take the big hit. And that's normally the case because of the option expiration. You get a lot of head fakes. You get a lot of just manipulation, counter trend, just flush and rip roll and smackdowns and avalanche and just moves that are tremendously high. And these discrete level moves, typically what happens is the IV curve just shoots up, especially on the Friday where the intrinsic value is almost gone. So what I'm gonna start doing on Friday, and that's what I did for this week, is for Friday I'm actually gonna be using the options expiration from the previous week. Now I will also use options for the current date, which is the day that is the expiration of that day, for that week. But I'm going to use a lot of also options from the previous week because you can see that the results on Monday through Wednesday and Thursday are pretty good because there's some intrinsic IV value, but then on Friday it starts to drop a lot, except when they rip roar, and when they rip roar and they take these tremendous moves, and I'll show it to you in the charts. That's when you're bound to lose the most. So you got to be careful for Fridays. In fact, if you don't trade on Friday, it might even be better. You might even want to take that day off, and that might be something you want to do. But for the week, I made 8,400, and I'll show you live for Friday. Um, let's pull it up. While that is getting pulled up, I'll show you. Here's Amazon, and what I want to cover is how Amazon looks on the daily charts. It's important to kind of understand the overall picture. You also want to look at the weekly chart, but I'm not going to cover that today. Just for the daily charts, you want this 5 day moving average, simple 5 day moving average. You want to pay attention to it. You want to pay attention to the candles and the movement of the candles. You want to pay attention to the volumes. And the 20-day moving average is also important. Now, the other moving average, like the 50-day moving average, these are exponential, by the way. 50, 20, 50, 100, and 200 days moving average are exponential. And they are, to 20 is important. The 50 are more trends. You can see these are uptrends. And you can also use the Maclaurin oscillator to predict when there may be a reversal. Like this is a red candle, so this is a potential reversal. And that's what I'm playing. I'm playing for a potential reversal next week. In fact, the whole week I was playing for a potential reversal, and I was incorrect, of course. But I still made money, so I was counter trending the whole week. Had I played more puts, and had I played the correct trend, which is more of an upward trend, especially on Tesla, I would have made a lot more money. But just looking at Amazon for the daily, you can see how there right now is a pattern, and these patterns can change at any time. But currently, you can see the pattern where it's a seesaw and then a rip higher, seesaw down, then a rip higher, and right now it's a smaller seesaw going higher, and then a rip up. So it's at pretty much the all-time high. Amazon like to be at levels. So right now, and when I mean levels, it likes to be at even numbers. Like right now it's 3,300. The next even number is 3,200, 3,100. So going back to this point, I wanted to just cover that these are very good potential moves, right? So if right here you got in long term on this doji of the 20-day moving average, this is a perfect reversal candle. You want to look for this doji pattern, and we call this a candle with a tail. And the reverse would be like here would be a candle with a wick. Okay, these are all doji candles. So doji candles are reversal candles because what it does is it shoots all the way to the extreme and then it reverses. And that's why when the reverses produce a tail, a shadow, a wick, and these candles are reversing patterns. So at this point, you got a 20-day moving average. You got 2 days of red candles, and you can see the McCullough oscillator is also red, going toward the negative end. Now, had it broken down the 20-day moving average, a lot of traders and day traders are expecting at this point that it would breaks down below the 20-day moving average. You would have a very rapid move down, and this McCullough oscillator would go negative as normally it would. However, they defended the 20-day moving average, and so what happened is a rip higher, a lot of shorts covering. This point right here, if you did buy calls or you sell puts, buying calls will produce you long-term wise, and I mean long-term being um, um, more than a day, short term, not long term, but short term, but not day trading. You would essentially gain. This looks like a 10-20x gain on your options, a huge gain on your options. So that's a potential gain that I did not catch and I did not produce. So I'm missing out on these gains that I like to get. But anyhow, at this point you have a reversal candle. This is a doji with a wick. And you can see it's a high volume red day, a reversal candle. And you can see the McCullough oscillator is also red and it went down the next day as well. So this is where if you got in and sold the calls, you would have produced probably 5-6,000 on those options all the way down to this 20-day moving average. And then again, they defended the 20-day moving average and move it right back up. So here you can sell the puts and get another 5-6,000. And here, of course, here a lot of traders were expecting it to go higher. It didn't go higher. It didn't produce that wick signal. But still, it's once it started to reverse, a lot of traders did sell calls, and if you did get in, here it broke down the 20-day moving average. So that right here would have been very bearish. However, there's a wick right here, and so it started. Of course, it it could have easily gone to the 50-day moving average, but it's not because we're in a positive bias in the market, positive territory. So of course they defended the 20-day moving average again on this candle, and it went straight back up. So you have a seesaw pattern and easily trading. As long as you pay attention, and if you would have gotten in at the wrong moment, or the trend, the pattern didn't go the way you thought it would, you could have still gotten out with minimum loss. And why I say minimum is because the IV curve on these premiums on these puts is so high that even when it stays the same or move down a little bit, the next day the IV deterioration, the intrinsic value that deteriorated from one day to the next, has to be at least 20 points, 10, 20 points for you to lose money. I mean, that's literally why selling options is the best strategy. Um, yeah. So here's my gains, 8,400 for the week, mainly using Amazon's. Okay, so I want to cover the setup for the intraday, which is what I use mainly. So the intraday is a 5 minute candle. It's important that you see that I use the 5 minute candle. I don't use the 1 minute candle. I don't even pay attention to the 1 minute candle. And because the 1 minute candle, the movements are too rapid, and if you follow the 1 minute candle, you're bound to get head fakes and tricks and just false signal. Just watch the 5 minute candle, and within the 5 minute candle, you see movements, right? It's just moving, and these little movement, where it's going up and down, you can actually see the volatility. You can actually see if it's going the back, if it's counter trending, if it's pushing higher, because you can see the volume developing. Whereas if you watch the 1 minute candle, it's all over the place, and it's just not recommended. Use the 5 minute candle and pay attention to the wick. These are wicks. Pay attention to the doji and the reversal, and you can get them. You can sell your puts and sell your calls at these points, and I'm going to show you right here. Right, you can these where I circle, these are the points where you want to pay attention to. And when you have a digital clock, you got to have a digital clock, so you can see the formation when it's about to go to the next candle within 30 seconds. Sometimes you want to wait for 10 seconds, 20 seconds, whatever. 30 seconds toward the next candle. Sometimes you want to wait for the next candle to develop to see how that's forming. But either way, you want to wait till it's about to go to the next candle and you want to get in during the formation, when you know that the wick has established. Now, if you get in too early, right, this is the formation at the end of the 5 minute. So when this is being developed at the very open, it can be anywhere here, right? So it can be moving up and down, whatever, right? And that the volume is getting developed. If you see the doji at that point, it doesn't mean much because the candle has not been formed yet. So you want to wait till it's almost formed, 30, 20, 10 seconds, from the next candle. At that point where you're sure that this signature has developed, that's when you want to sell your calls. And conversely, that's when you want to sell your puts. And this is the cleanest strategy. I mean, you can see these doji candles, with the tails, with the wicks, everywhere, everywhere. And if you continue to look at the 5 minutes, you continue to look at the intradays, you'll see these very clearly. Now, I have tons of charts that I pretty much, I recorded and I screen captured and wrote notes. So I'm not going to cover everything because there's so much. The only other thing I want to cover is the setup for the intraday. So you got the 5 minute. And you can see that this one has, this is a nice, you see all these little wicks and tails. These are very nice signature of reversal. I mean, it's just so clean. You want to add on your studies. Where's the studies at? Here it is. You want to add the VWAP, which should be a top study, but it's not. The VWAP is the best indicator, and here's the VWAP. And you can see it's normally A lot of time they overshoots the VWAP a little bit. So looking for the overshoot of the VWAP just slightly when it's forming this wick is probably something that is you want to wait for. Sometimes it doesn't overshoot, and sometimes it do overshoot. So having a consistency on just this is more or less just your instinct on whether it will overshoot or not. The more experience you get, the more you see. Also, afternoon trash. Essentially, in the afternoon, it's gonna go above the VWAP. It's gonna overshoot or undershoot the VWAP because of afternoon trash is just 100% manipulated. The other signature that the other indicator you want is the moving average, and you want the 100 exponential moving average and set up to a different color. So this is a secondary. It's not as good, so you gotta be careful that a lot of time they will not react and just overshoot, especially when it's close to the VWAP. Um, yep, here it reacted, but you can see here it shoots and it went to the VWAP. So don't don't follow this 100-day moving average too closely. It's just a secondary trend, secondary signal. The main one is the VWAP. So yeah, that's what I want to cover today, and hope you enjoy the video.